Good morning and welcome this morning to Introduction to Cryptocurrency, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm going to be joined here in just a moment by my good friend Jim Ferrioli, who is the director of crypto trading and strategy at Charles Schwab. And we're going to bring Jim into the discussion in just a minute. I'm also joined out in the chat by my good friend Michael Fairborn, another great educator and education coach here at Charles Schwab. He is there to help facilitate the conversation. And of course, we are being joined by all of you, whether you're here with us live or whether you are here in the recorded version of this webcast. The advantage you have of being live is you get to ask us questions. The advantage you have of watching this in the recorded version is you get to stop it and start it and go back and review. You can leave us a comment there as well. So be a part of that conversation. And thanks to all of those of you who are here for the first time coming to this particular webcast. We're going to give you some additional resources about where you can find additional information, not only about cryptocurrency here at Charles Schwab, but also all of our webcast offerings as well. We just simply ask that you give us a follow. Click on that subscribe button down there at the bottom of the page. Now, before we get started, one of the things that we need to do is take care of a couple of quick housekeeping items. Cryptocurrency is a rapidly evolving space, and as such, not all of the risks are known. But a couple of things that we do want to talk about, and that is simply first and foremost, nothing that we talk about today should be considered to be any kind of a recommendation of a particular security or strategy or account type or anything else. We're not soliciting for any particular product or anything else in this discussion. It is for illustrative and educational purposes only. We're going to use some technical analysis as we start to talk about some of these individual names in the crypto space later on in the webcast. Schwab doesn't recommend the use of technical analysis as a sole means of investment research, past performance, no guarantee of future results. A couple of things to think about when it comes to digital currencies like Bitcoin. They are highly volatile. They're not backed by a central bank or a government. We talked a little bit about that last week in session 1 of this Introduction to Cryptocurrencies webcast series. Digital currencies lack many of the regulations and consumer protections that legal tender currencies and regulated securities have. There is a high level of risk. They are a speculative instrument. Cryptocurrency-related products carry a substantial level of risk. They're not suitable for all investors. Make sure that you understand or have an understanding of the characteristics and risks of these products before considering transacting any of these products. Now, that being said, because it is, as I mentioned, a ongoing, evolving space, the technology related to digital assets, including blockchain, it's new and developing. Risks associated with digital assets may not fully emerge, and the regulatory environment is changing. So be aware of that fact that this is by no means settled science when it comes to the risks associated with these products. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money platform. Not a guarantee of future success out there in the real world. However, it's a great learning environment, but there are some differences, including where orders may fill. So just be aware of that as you move your practice from paper trading to live trading as we get into this discussion. Now, I want to bring in my friend Jim Ferrioli, again, Director of Crypto Strategy and Trading at Charles Schwab. Good morning, Jim. Welcome to our webcast series once again. Good to have you with us.
Hey, Ben, good morning. And good morning, everyone who's joining live.
Yep. So what we want to talk about is just kind of setting this up, because I know that we've got a lot of new attendees in this discussion. We've gone through this 4-part series once before. This is session 2 of that 4-part series. This is our second time through the rotation. So last Monday, we talked a little bit about the idea of what is cryptocurrency, kind of that broad overarching definition. Today, we're going to focus our efforts on how does cryptocurrency work. One of those areas that I have a feeling many attendees today have some questions about. So we're going to take your questions along the way. Again, Mike's there to help facilitate those as well. Next Monday, we're going to talk about how people get exposure to cryptocurrency. And then we're going to talk about how the driving forces, what they are in terms of driving cryptocurrency price, how those relate to the products that we see and have can gain exposure to cryptocurrency, and some of the market dynamics that are at work. Those are some of the other questions that I've had both in social media as well as in other spaces. So, speaking of social media, you can follow me on X at Ben Watson CS. You can follow me on LinkedIn, and I'll let Jim at the end of the discussion here talk a little bit about where you can find his follow-up information and some of the products that he puts out as well. So we are on session 2. How does cryptocurrency work? So our focus, Jim, in this process, in lesson 2, how does cryptocurrency work? We're going to talk a little bit about blockchain basics. We're going to talk about the idea of proof of work versus proof of stake. And we're going to talk about the idea of wallets, and we're going to examine some of the companies that have cryptocurrency exposure. But I wanted to ask you a question really quickly, Jim. Um, since last week we talked about the idea of what is cryptocurrency, what are some things that attendees and investors should be taking into today's discussion from what we talked about last week?
So some of the things that I would recommend is, we talked about cryptocurrency. So this talks about more of the use case. Why do cryptocurrencies exist? How do they function within the blockchain ecosystems? They were created to function within these different networks. And so that would be important. And then um, how to store them, right? There's benefits of
Right.
different types of storage. There's also ease of access of different types of storage. And so those are some of the things that I would recommend to focus on here.
Cool. Okay, so Jim, let's talk a little bit about this idea because these two words and concepts go hand in hand by necessity when we talk about this overarching space of cryptocurrency, crypto and blockchain. What's a way to maybe explain blockchain? I know we touched on it last week, but explain a blockchain in very simple terms.
A blockchain is just a distributed ledger. It has a historical set of transactions, and each transaction has a copy of every new transaction rather has a copy of every existing transaction that's ever happened. And so a lot of these ledgers and payments networks, they have their own currencies, and so the cryptocurrencies are the native currencies of these blockchain ecosystems. And so that's one aspect of crypto. And the other thing that I would point out is these are encrypted transactions. And so each transaction, each output on the Bitcoin blockchain, which miners when they're looking to solve the latest block, they're encrypting an output and looking to produce a certain value that will give them the reward. So encryption is key to this. It's a way to make sure in a public decentralized nature, you can have this public payment system without identifying who is who. So there is privacy that comes with it, but the cryptocurrencies are the actual native currencies of these blockchains.
So, Jim, what's an example? And I think this is maybe a way to kind of add some context to this. What's an example of um, a transaction on the public ledger on this blockchain ledger that investors might be familiar with? Is it just payments, or are there other things too?
Yeah, great question. So there's nothing actually stored. It's just information. And so you're sending a transaction, if I want to send Ben some Bitcoin, I'm feeling generous, I want to send him 10 Bitcoin today.
Mhm.
What I'm doing is from an address that I control, I'm sending a message to the blockchain network, and I'm telling it to um, credit Ben with a certain amount of Bitcoin. And so that's what a transaction is. Every 10 minutes, a new set of these transactions are approved. And so a new block is produced. And so, again, a blockchain is quite literally a chain of previous blocks of transactions. Um, the miners and validators on the Bitcoin blockchain, they race to produce a certain output. The first miner that can produce the correct output is credited with a reward of Bitcoin and a share of transaction fees for doing their work to maintain the historical blockchain network. And so every new block becomes a permanent record of previous transactions. And it's designed like this so it's a secure, transparent, and accurate way of managing a public ledger. Public blockchains are referred to as trustless. How do you have a public network with no central authority to approve transactions? By trusting no one on the blockchain. If one miner doesn't trust another miner, you can assume they're always going to work in their best interest. And so again, through this trustless system, the a permissionless, trustless public blockchain can function. And so again, to recap it, big picture, when you're sending a transaction, you're just sending a message to the blockchain.
Right.
And then this race kicks off every 10 minutes to approve the latest set of messages and update the ledger of saying, this wallet is associated with this balance, this wallet is associated with this balance.
Interesting, because I've been thinking about this as you've been you and I've been talking about this over the last couple of weeks. You the purpose for decentralized finance, right, and decentralized transaction records, this public ledger, is the difference between if we had one single server that was holding this entire list of transactions, then everybody would have to put their trust in that one entity that held that list. And that could be compromised, and therefore, then everyone's transactions would be at risk. However, with decentralized finance, with this blockchain idea and it being a public ledger, and I love the way that you put it, trust no one, we don't trust any one single entity in that blockchain or that maintains that ledger. But because there are so many entities holding that same ledger, there's an automatic validation. And that's where the blockchain process of mining comes into place, right?
Exactly. And it's one of the security features of blockchains, where if you have enough computing resources to theoretically try to launch a dishonest chain, you would actually be rewarded more for using those resources for good and maintaining the accurate chain. Because what would happen if you launched a dishonest chain? The rest of the network could do what's called a fork, and they would say this is not the correct network. They would exclude you from the network, and as a result, you're now cut off from the network. And so again, there's this self correcting mechanism of when you have individuals, whether they're entities or people, competing to make sure that the correct version of the blockchain is maintained.
So I want to ask, maybe this is kind of half a step question back to the origin of this, but K Brown asks in the chat, where do the transactions come that then get put into that public ledger?
Yeah, so there's what's called a mem pool. It's a memory pool, and it's just like I said, every 10 minutes transactions are made. So as I send transactions to Ben, they're stored in really essentially short-term storage. And every 10 minutes, the miners on the network, they go to this mem pool and they say, okay, this is the most recent block of chains, block of transactions. Let's approve them. So they're always looking at that most recent kind of shorter term data. And then every historical version doesn't actually need to be stored in this mempool because you already have this permanent history. So that's where the intermediate term transactions are stored.
Okay, so now let's kind of move into the kind of nuts and bolts, if you will, of this blockchain idea and the relationship to cryptocurrency. So we've got this distributed network of public ledger. It has to be maintained. You've got constant flow of new transactions that are coming in that need to be validated. And you need to have an incentive for entities to validate those transactions in order to maintain the overall integrity of the ledger. There's a process to that, and that process takes something. It takes some input or work or validation, right?
Correct. Yeah. So most blockchains use what's either called proof of work or proof of stake. And so, as we talked about in the last slide, Bitcoin, the largest cryptocurrency and the largest and oldest blockchain, that uses something called proof of work. And that what you're putting in is actual energy. The costs to run a Bitcoin mining center are they're high. And so again, there are actual costs associated with maintaining the Bitcoin blockchain. And so the idea is you're doing the work and you're going to see the results. So a good analogy that I've heard about this is Proof of work is kind of like going to the gym. I can say I go to the gym, and you can't really tell because I have this suit on. But if you saw me in person, you probably wouldn't believe me. You know, if I was very strong, very muscular, you could see I'm doing the proof of the work that the results show in what I'm putting in, what I'm getting out. And so that's really the idea behind the proof of work. It's verifiable that this miner, this validator is truly doing the work to secure the blockchain. Proof of stake is different. This is similar to putting funds in escrow. What happens is validators will put forward a certain amount of their own cryptocurrency and say, this is the correct version of the blockchain. I've maintained the historical version and look at, here are the most recent set of transactions, and this is the correct version. Other validators on the network will then look and say, okay, does their version match our historical version?
Mhm.
Yes. The new current set of transactions, does that match what we show too? Yes. Okay, that's correct. And so in that case, the miner that first put forth those transactions for validation, they will be rewarded new cryptocurrency. If they put either a false history of the blockchain forward or a false set of recent transactions, the cryptocurrency they put in escrow will now be forfeited. So again, it's a function to keep the chain honest. If you're going to try to lie or maintain a false version of history, it's going to cost you, and ultimately that version of the blockchain won't live on anyways. It won't end up getting approved, and you'll still lose the funds you put forward. So it's two different methods to try to um, come to a consensus on what is the correct version of maintaining a blockchain. And the reason they do this is comes down to cost. There's a lot of energy costs associated with
Mhm.
maintaining a proof of work system. This has been one of the criticisms of it. It's equivalent to about how much energy is used in air conditioning across the world, right? And so that's kind of a similar amount of energy used. Also, the amount of energy used in Christmas lights, actually. So,
Huh.
air conditioning, most people see as kind of like that's something you really need. Christmas lights, if you celebrate Christmas, are nice, but you can make the case they aren't technically necessary. And so that was the criticism that a lot of people said for proof of work, and why proof of stake is then more efficient because it doesn't have nearly as close to the same energy cost to maintain the blockchain.
It's interesting because you think about, and I'll follow up with Kay Brown's question, which is, how often does this bad actor type of, nefarious activity happen? And I think you've done a great job in explaining this, uh, both this iteration and the past iteration, that the energy required or the amount that's being escrowed to validate the blockchain prevents that possibility from happening. Because if somebody were to try to come in and spoof the ledger and create a false ledger, despite the fact that it would get forked away very quickly, they would have to expend so much energy to create that false ledger to get whatever reward that they were trying to seek, that it just does not make economic sense
Yeah, I can
to do that.
provide some context,
Yeah.
I don't want to like stay too long on this, but so we've actually done a fair amount of research on this, and so there's billions of dollars in Bitcoin transactions that settle every day on the Bitcoin blockchain. If you had enough energy or money really to build out the infrastructure needed to kind of maintain or capture enough of the Bitcoin blockchain to put forth a false version of it, you could theoretically capture the mining rewards for several blocks and transaction fees for several blocks. And maybe you could capture a couple $100 million in blockchain through what's called double spend. Now, that sounds large, and it by a couple million, 100 million, like $300 million is a lot of money. But if a couple $1 billion settle on the blockchain, the Bitcoin blockchain daily, it would cost you billions and billions of dollars just to have the required infrastructure to build this out. So it's this one-time gain of
Yeah.
$300 million for something that could cost you tens of billions of dollars to build out. So it's really not economically feasible. The other thing that miners are doing in a proof of work blockchain like Bitcoin, so this is a highly competitive, highly energy intensive. And what they're doing, they're solving cryptographic math problems. And so to just highlight how difficult it would be to actually succeed in that, if you look at the biggest miners are publicly traded. Mara is the largest
Right.
miner. They control about 7%. The amount of computing power that they have represents 7% of the total Bitcoin blockchain's computing power. We call this hash rate. If they wanted to consecutively change the previous 6 blocks, they would have to do that before every other miner on the network solved the next block. And so we can quantify this with math and say, okay, they have a 7% network share. For every block that they want to change, we have to raise that 7% to that exponent to what's their probability of doing this six
Right.
times in a row before the next block can be mined by the entire rest of the network. And so if you want to change to 3 blocks, it's 7% to the power of 6. It's a random process of outputting the correct output. And so it's mathematically probability, it's very low likelihood that you can even do this. And so aside from the costs associated and the relative minimum amount that you can extract from the blockchain, it's from a math perspective highly unlikely that you would ever even achieve it. And so
And oh, go
go
ahead.
ahead, Ben. Yeah,
I
I
was
was
just
just
going to
gonna
say
say,
this is yeah.
this is why the proof of work blockchain works for a large distributed ledger,
Yeah.
and why ultimately it doesn't require a central authority to say this is true, that is true, and why, if you have the resources to theoretically build out the infrastructure to mine, you're better off just using them for good, because then you can pool your resources with other miners and participate in the economics of the broader network.
And there's the reason for the blockchain to exist in the first place. And this is a feature, not a bug. And I think hopefully this allays some fears about distributed finance and the idea of the blockchain. Now let's pivot real quickly here to proof of stake, because this is a
Mhm.
little bit different. This is that putting up that escrow amount that then would be sacrificed if there is a break in the chain, right?
Yeah, and this is an important difference. And so it's a different method of validating the chain. Um, as miners maybe or validators leave the chain, the amount of reward that is paid to the is the same. And so there's this inherent mechanism that as validators temporarily shut down or leave the network, your motivated to stay on it and continue validating because now you get a higher share of these validator rewards. But so it's a completely different method. It's not energy intensive, but it's still trust based. If you're going to put forward a certain amount of your cryptocurrencies to approve the correct version of the blockchain, the most recent transactions, again, you're rewarded for doing it in an honest way. You're penalized for doing it in a dishonest way. And so that's really the core function of proof of stake. But there's a really important thing to think about that's different than a proof of work blockchain. In a proof of stake blockchain, such as Ethereum, when your funds are staked, they are locked up and illiquid and they cannot be traded. Now you can unstake them. There's a process to do that, but it doesn't mean there's at that moment liquidity. Roughly 30% of circulating Ethereum is staked, which is good for network security. That tells you many Ethereum holders, Ether holders, they are using their Ether to stake it and provide security for the blockchain. And now they're also receiving rewards for that as well. So it's almost like earning a stock dividend. But the other aspect is that it can impact the liquidity because at any given
Sure.
time, there's 30% of Ethereum that cannot be traded. And so again, you have to go through the process of unstaking your Ethereum. And so it's not a automatic process, it's not an instant process. And so that's a really important thing to consider because if you go to other blockchains beyond Ethereum, that's a feature of them too. And so you should always be aware of how much is actually tradable and liquid versus what's
Sure.
staked and how long it can take for funds to become unstaked.
Interesting. So one thing I do want to just mention really quickly, because you did mention the idea of dividends, there are companies that have exposure to cryptocurrency that do also pay stock dividends, dividends from their profits. So dividends in a stock is different than the explanation that Jim gave. Dividends can and do change. They can be stopped at any time. So just be aware of that. Whereas with the proof of stake in a blockchain environment, those rewards for validating those chains, while they may be similar to a dividend, they are not the same thing as a stock dividend in owning a share of stock. So, Jim, real quick, one question that came up, and Keith asks this question. I think it's an absolutely appropriate question here in this discussion, which is, and Hollywood would certainly have us think this case, how does quantum computing change the assumptions about and the economics of validation and blockchain and the security of distributed transactions?
Great question. So quantum is one of the most talked about topics in crypto. These are open source computer networks, and they use literally computing power to maintain them. And so one of the near-term focuses for quantum computing is what happens with these older hardware wallets. There's some
Mhm.
wallets that are cold wallets, essentially like hard drives that have existed since Bitcoin's existed, and they have lower security features than kind of more modern wallets. And so there's fear that those are the first wallets that are at stake. Now, the network is not at stake, but theoretically, these older wallets, their encryption could be hacked through quantum, and that could lead to someone having access to the cryptocurrencies on those. And so there's roughly, there's estimates of anywhere from 1 to 4 million Bitcoin that could be exposed here, very early age um, cryptocurrency. What it means for the actual network. Theoretically, higher computing power through quantum would mean that the validators on a proof of work blockchain could produce the correct cryptographic output faster. In that context, it's less of a concern in my perspective because you would have quantum miners competing with quantum miners. And again, it would take uh, more time, less time for an individual miner with quantum. But if every miner on the network has quantum computing, again, it would balance it out. So the real short-term risk is what happens to kind of legacy crypto holdings that are stored in these older wallets. And so that's something we watch closely. And it's something to think about. One of the risks with this, I mean, so quantum impacts everything and not just cryptocurrencies, but
Sure.
the risks specific to Bitcoin is that it's a distributed network. To make a change in the network, because there's no central authority, it requires broad network consensus. So that means all the holders of Bitcoin need to be supportive of
Sure.
it. All the validators of Bitcoin need to be supportive of it. And so you really need to get a broad majority to agree this is the right steps to take to quantum proof the blockchain. And that's what makes it so difficult because there's no central authority to say this is the right way to do it. There's lots of different opinions to do this. Some have been put forth where they say, well, we can just take those early wallets and freeze them permanently and we'll move on. And that way there's less of a risk. We know that with enough notice, if they're live wallets, people can access
Mhm.
them and move their cryptocurrencies to more modern wallets. And if they don't move, we know that it's cryptocurrencies that are no longer accessible. Critics of that will say, well, by that, you're essentially confiscating someone's cryptocurrencies. Maybe they just don't want to move it. Maybe they don't feel quantum is a risk. And so, because of the fact that there's no central authority, it makes it very difficult to actually make this change. Whereas if you were to look at the government or
Right.
a company, there's people who could actively work on this and they're there to make the decisions and see them out. And so that's why people view it as a higher risk for a decentralized network like Bitcoin or Ethereum, where you really need broad network consensus to approve it. So that's the biggest risk.
Interesting. So one thing that you mentioned in terms of crypto computing, and I think this is a kind of an overarching thread that we're going to explore more as we get into the fourth session, which what drives cryptocurrency prices, is we might make the statement that the cure for faster computing is faster computing, right? Because if you have this arms race to get to quantum computing, that arms race is going to bring other quantum computing exposure stocks and companies to the market so that they can compete in that space, either to protect what they have or to find what's out there, right? If
Correct.
that's
And
the
so
case, yeah, then you've got, again, semiconductor arms races, you've got quantum computing stocks that are fighting against one another to get to that level, right?
exactly 100%. And I just wanted to
Yeah.
put some clarification around that. Much of the work that's done in quantum computing so far, that's worked in simulative environments on test cases that can't really work in real life. And so it's very far away. I want to touch on the network security aspect quickly. If
Mhm.
without quantum computing, if you wanted to try and um, break the Bitcoin encryption, Bitcoin uses SHA-256. So this was developed by the NSA. To do this with just random outputs, it would take approximately 2 to the power of 256 attempts to produce the correct output. That sounds like a small number when I say it like that. There's estimated to be 2 to the power of 266 atoms in the universe. And so, excluding quantum, the risks of the Bitcoin network encryption being broken are very, very small. And so I do want to provide that as some context as well.
Sure. So, Jim, let's pivot to this idea about wallets. You've mentioned this, you talked about cold wallets, you talked about some other aspects. Let's talk about why wallets are so important on a individual level. So we've dealt with the proof of stake, proof of work side of the equation, the validators. Let's shift now maybe to the companies that hold cryptocurrency or individuals that hold cryptocurrency.
Yeah, so wallets are very important. These essentially hold your passwords that give you access to your funds on the crypto network. If you think about an address, that's a that's where cryptocurrency, a record is stored that says you own, this much cryptocurrency. Ben owns this much cryptocurrency. A crypto address is very similar like a Bitcoin address. If you know the address, anyone can send an email to it. Now, the only people who can access that email, they have to have the correct password. And so that's what a private key does. It gives you access to that specific address as opposed to just being able to send funds to it. There's different types of wallets. And when you're looking at crypto wallets, you're doing a balance between security and convenience. So a hot wallet is a wallet that's always connected to the internet. So like anything else digital, there are risks associated with that. So there's lower security, but higher convenience. It's some often hot wallets are native to exchanges, and so again, like, you don't need to store something physically. You can just log into an account and have access to your cryptocurrencies. And this might be helpful if you are a frequent trader, but again, it makes you more vulnerable to hacking and malware at the wallet level, not the blockchain level. A cold wallet is the complete opposite. It's very secure, but it's very inconvenient. Many cold wallets are similar to USB hard drives. You can put your cryptocurrency holdings in them. You could put them in a safety deposit box. You can keep them in your sock drawer, wherever you keep them. But then there's the risks of storage. What if you lose access to them? That's a risk. What if someone needs to access them on your behalf? They don't know where it is. That's a risk as well. If you're a long-term holder and you have a good storage mechanism set up, that's fine. But the risk here is if you are more of an active trader, that means every time you want to place a trade, you're running to your safety deposit box or wherever you keep it to get your cold wallet out, plugging it in, doing the transaction, and putting it back. So there's a convenience trade-off. Warm wallets, they balance the features of security from the cold wallets with the convenience levels of hot wallets. And then you have custodial wallets. These are managed by a third party. These are often hot wallets. Um, when you're investing in a cryptocurrency ETF, the ETF is custodying the assets for you. Again, so it's a custodial wallet, a self-custodial wallet, higher security. Again, this is a cold wallet, lower convenience. And so it's just a trade-off between security and convenience when you're thinking about wallets.
Interesting. Okay, so we know that that crypto wallets, whether they're hot or cold or warm, have some components and some protections in terms of protecting those strong passwords, seed phrases, two-factor authentication, and like you said, a secure location, maybe putting it in a safety deposit box, or the literal cold wallet. The example that I heard about the other day is the reason it's called a cold wallet is some people will take their cash and put it in a block of ice in the freezer. So in order to mitigate their access to their cash, they have to unfreeze or thaw that capital out. So same kind of thing, that cold wallet gets put in a place where it becomes difficult to get to as a security measure and as a means to dissuade frequent access to that product, right?
That's fine. I never actually heard that on the freezers, but that makes a lot of sense to me.
Yeah, you put your cash in the freezer and you got to thaw it out to get to it. So Jim, let's talk a little bit now. Or actually, while we're doing this, let's get to one question that Daryl asks, which I think is an interesting question as we get into this next concept, and it is, how long do you think it will be before cryptocurrency, overarching cryptocurrency, becomes centralized and monitored slash regulated slash co-opted by banks and governments?
That's great, amazing question. We're already there. If you think in 5 years, uh, there's going to be a DeFi and traditional finance, I have very bad news for you. The the traditional financial world is already looking to adopt these technologies. Now you can look at kind of the very base examples. Great firms like Charles Schwab are offering crypto trading, right? We know we have clients that are interested in trading these. But beyond the trading aspect, financial institutions across the world are looking to adopt blockchain technology, right? From the benefits of fast settlement, low transaction costs. And so it's going to happen already. The Senate is currently working on a regulatory bill. It's a market structure bill called the Clarity Act. It's already passed the House. And so regulations are coming. The SEC came out early this year and they interpreted existing laws to provide a framework for thinking about investing in cryptocurrencies. And so this Clarity Act would actually cement some of those changes, some of those views as law. And so it's already happening. Proponents of the digital assets industry, they're very happy about this, right? It's showing success and mainstream adoption of this.
Mhm.
While some of the most earliest investors kind of dislike it. They like crypto being as this opposite, this outside the traditional financial system. It was designed to be its own independent monetary system. Why integrate? So you're never going to make anyone happening. And just like in any market, there's always someone buying for some reason. There's always someone selling for another reason. Both can be right and wrong at the same time. It really
Sure.
depends on your perspective. But if I had to make the bet, the paths are clearly converging. And so that the
Yeah.
best ideas in the traditional finance industry will probably live on. The best ideas in the crypto industry will probably live on, and you'll have a kind of emerged uh, financial industry.
Cool. Well, Jim, as we talked about last week, we looked at some of the ways that investors can gain exposure to cryptocurrency price movements. And I think that's what a lot of trader focused attendees are kind of thinking about is the idea of, I want to benefit, because this is in the headlines. I want to benefit if Bitcoin goes up, or I want to benefit if Bitcoin goes down. There's a lot of different ways that can be approached to trade that. We talked about trading futures, we talked about trading spot, cryptocurrency to a certain extent, and looking at charting those as market measures. Now, I talk about trading crypto futures among other futures products in my Tuesday morning trading futures webcast. So we're not going to talk about that here, but I've got a watch list. I'm on the Thinkorswim desktop software platform, and in the few minutes that we've got left here, I want to talk about some of these individual names that have exposure in one way or another to cryptocurrency, not just necessarily Bitcoin, but cryptocurrency in general, and not just necessarily miners or holding cryptocurrency, but also some of the halo around cryptocurrency. So I'm going to start with one that you mentioned earlier, and that is Mara. Just remember, none of these are recommendations. These are simply illustrative and educational examples, and this is not an exhaustive list. So, Jim, let's talk about Mara, and then let's also talk about some of the companies like PayPal, for instance, and then kind of go outside that space with, say, for instance, a Tesla.
Okay, yeah, sure. Sorry, I like spaced out there for a moment. So
Yep.
Mara is the largest publicly traded Bitcoin miner. So their exposure to Bitcoin is literally a function of the fact that they acquire Bitcoin by mining it, so they hold it on their balance sheet. Miners are often viewed as levered proxies on Bitcoin, similar to how gold miners are viewed on gold. They earn US dollar profits. As the price of Bitcoin rises, their profit margins expand, and that kind of lends itself to the leverage factor on their stock. So that's one way to think about a holder of Bitcoin or a Bitcoin stock. Coinbase is a cryptocurrency exchange. And so their exposure to cryptocurrencies comes when investors buy and sell cryptocurrencies. Now, all of these companies tend to have high correlations to Bitcoin. What's happening in Bitcoin tends to reverberate through the rest of the crypto space. And so if people are buying Bitcoin, they're also buying other cryptocurrencies. And so that lends itself to a performance on the exchanges. And then finally, you have companies like Strategy. Strategy is a publicly traded software company. They actually have a very small software business. But what they're known for is they acquire Bitcoin. They hold roughly 800,000 Bitcoin. And so they're essentially making the bet that using this corporate treasury strategy by acquiring Bitcoin over the long term, they think Bitcoin will appreciate more than the dollar will. And so they're making a bet that um, long-term growth will then benefit them as a holder of Bitcoin. And so there's different ways to get exposure, and it's important to think about that. Whereas Mara, again, this is a company that's mining Bitcoin with the intention of, yes, benefiting from holding some, but producing US dollar profits. There are companies like Coinbase. Again, they're involved in the industry, but they're really trying to earn dollar profits. They're looking at transaction fees and other sources like services revenue, things like that to grow their earnings. Whereas a company like Strategy is really just trying to benefit from the long-term appreciation that they perceive they will see in cryptocurrencies. So there's big difference. And then there's another type of company that's important to point out, Tesla. Tesla is a company that makes cars. They do hold Bitcoin in their treasury. And so they're often included in these Bitcoin treasury stocks. But it's important to denote, or it's important to point out that the core driver of Tesla is not Bitcoin or what's happening in crypto markets. They can benefit when you see rallies and you'll see the value of their assets marked higher, but they are not, and they shouldn't be perceived as Bitcoin proxies.
Interesting. So what I've got here is a chart, just a 1 year daily chart. And this purple line that I've kind of kept consistent throughout all of those different stocks that we just talked about, Mara, Strategy, Coinbase, now Tesla, is a comparison against /BTC, which is the Bitcoin futures continuous contract. We're using that as a proxy for understanding that Bitcoin price. So you can see that even Tesla, which is disassociated somewhat from that Bitcoin price, there is some correlation to the price of Bitcoin simply because of the number of Bitcoin that they hold in their treasury, to Jim's point. But if I were to change the symbol to Mara, which is a miner, you can see that again, there's some correlation, but there is some divergence between those two. As the profit of the company changes, they don't just hold Bitcoin. Bitcoin is what they do, not who they are necessarily, I think is maybe the way to think about that. But you look at a company like, as you mentioned before, MSTR Strategy, which primarily holds Bitcoin. That is their company, right? Holding that Bitcoin. You see the very, very close correlation between the price of Bitcoin and the price of the stock itself. The relationship is there between those two. So investors looking to gain exposure could use companies like these. Again, these are just simply illustrative examples to gain different levels of exposure and different pure. I want to say it this way: purity of exposure to the product maybe is the way to think about it in terms of that. We talk about it being a pure play or not a pure play.
Yeah, just a quick comment there is, and we actually published an article on this. It's on the schwab.com/learn page, is one of the ways that investors have used these different types of Bitcoin exposure in stocks is to play the Bitcoin cycle. Typically early on in recoveries after bear markets or very late cycle, owning Bitcoin has been advantageous because everything else is a more volatile proxy of it. Kind of in the intermediary phase where prices have recovered, but they're still accelerating. The digital asset treasuries like strategy have outperformed because these tend to be a proxy for leverage. As we see leverage and open interest growing in futures markets, they tend to kind of exhibit the same type of growth in their price. And so we view them as a proxy for futures leverage. Later in the cycle, miners become very profitable. Bitcoin's trading at highs, their profit margins have exploded. And then very late in the cycle, typically you'll see other cryptocurrencies start to outperform. And so if you're an active trader, that's actually, there's a good historical narrative where you can think about if you want to be more shorter term in your crypto exposure through stocks and actual cryptocurrencies, how you can kind of do the trade-offs between the different types throughout the cycle.
So what I'm going to do here really quickly is I'm going to take you to the Trader Talks webcast page, which is on YouTube, youtube.com/at Trader Talks webcast. This is where you can find all of our recordings, including the short videos that Jim has done. I'm just going to type in the word cryptocurrency, and you'll see the amount of content that we have to learn more about this. So how does cryptocurrency week? Crypto concepts and definitions, and a variety of resources that we can gain information from. So all we ask is that when you go here, click on subscribe, give us a follow. As always, Jim, my thanks to you for helping us out with this. We're going to be back again next Monday to talk a little bit about more of this idea of how investors can gain exposure. And then we're going to talk about how cryptocurrency prices work. So look forward to seeing you back here next Monday with us. We look forward to seeing all of you back here again with us next Monday. Mike popped in there into the webcast, the playlist for this webcast series. My thanks to Mike Fairborn and our great production staff and our great reviewers. Jim, have a great week. We will see all of you again here on Monday. Take care, everybody. Bye-bye.